Let me first start off by introducing our Dean, Dean Schweig, who's actually, we both came to Kennesaw at in the same year. She came from Georgia State at that time, and I came from Buffalo. So she was used to the pleasant climate, and I wasn't. So without further ado, may I have the Dean say a few words.
Thanks so much, Govind. It's absolutely my pleasure to welcome you here tonight, and I've looked forward to this event for a couple of weeks since Govind sent me the email announcing the event. Many of you are from KSU, but many of you are not from KSU, and I just want to extend a welcome to our beautiful campus. We're very, very proud of our campus, and many of you have commented about how impressive the campus is. And if you haven't been on campus in a while, it's likely changed. It's ever growing and ever changing. You're actually right now sitting in what I think is one of the most beautiful buildings on campus, and is actually one of the most technologically advanced buildings in the whole state of Georgia university system. And this is home to our College of Health and Human Services. This fall, we will host over 25,000 students here at KSU. We're the largest producer of nursing students in the state of Georgia. Those nursing students are trained in this very building. We're also the biggest producer of teacher educators in the state of Georgia as well. And we're very proud of that. So KSU is a very exciting place to be. It's a very energetic place to be. We always think of ourselves as being a very entrepreneurial place and a very happening place. I will tell you, the Coles College is right in the middle of that energy, and we're a big part of generating the energy on this campus. Of those 25,000 students, we'll have about 5,000 of them in our programs, 4,000 in the undergrad level and 1,000 at the graduate level. This past May, we graduated our first doctoral students, and we were very excited about that. We have some wonderful programs at the undergraduate level and also at the master's level. But bringing it a little closer to home and related to this program tonight, I want to say one of the biggest priorities that we have in the Coles College is connection to the community, whether that be the business community or the thought leadership community. And back about a year and a half ago, we had the great privilege and the great honor of bringing the India-China-America Institute to the Coles College, and very grateful to Dr. Jag Chef for that benefit. And Govind has done just a tremendous job in his role as the executive director, and part of what is absolutely. And really at the heart of what Govind is passionate about is this kind of an event where we have conversations on important topics. Somebody said tonight, one of the things that we really need to focus on in the years to come is the idea of where business connects with society. And that's what this conversation is about tonight. So while this is not something that's in my area of expertise, when I saw the topic, I thought, what a fascinating conversation and discussion to have, and how proud we are to have this event on campus tonight. And we are so delighted that each one of you are here as well. So let me extend my welcome on behalf of the Coles College of Business. Thank you for being here. We look forward to connecting with you more. If you'd like to learn more about the Coles College, I'd be delighted to have a conversation with you after the event tonight. Thanks so much.
Thanks, Kat. I'm not going to... Hi, Holly. Thanks. Holly Sametko's from Emory has been a long-time participant and supporter and leader with the ICA Institute. She heads up international programs at the Holly Institute. She's the executive director of that program. Thanks for driving all the way. For those of you who are new to Atlanta, driving from Emory to here is a major challenge. And so thanks. What we've done, I'm not going to tell you too much about the ICA Institute. We have plenty of brochures. Visit icainstitute.org. Come to the Coles College website. There's a link from there as well. The ICA Institute and KSU entered into a partnership last February, February of 2011. And We're very glad about that. It's been an exciting series of activities around that. Dr. Barry Morris has been a big proponent of these types of strategic global activities. What we are doing today is the first initiative in what, since everything in an institute has to have an acronym, we are calling it IGAP. IGAP essentially is a mechanism or a series of initiatives through which we bring together leaders from industry, from governments, and from academia to look for collaborative solutions on specific issues. So the first initiative in that begins today with this collaborative solutions program on financial inclusion and the unbanked sector. So we'll do this for the next 3 months or so with a primary focus on India. Then we'll pick up the US, because the US also has the same issues in a very different format, different scale, etc. We'll look at solutions in the US, and then we'll repeat it for China. During that entire process, we'll bring in leaders on this topic from each of these 3 sectors. We have Professor Marcus, who's working with the ICA Institute in putting together, along with some students from both doctoral as well as MBA students. We have Cutler Nope, who's a recent graduate. These are all people who have gotten behind this initiative and are going to help us create a fantastic research document based on the deliberations that happened here all day, will carry on into tomorrow. So that is what today's program is, right? It's on financial inclusion and the unbanked sector. So this is the first initiative of the IGAP program. Financial inclusion essentially entails bringing everybody into the benefits that you can receive from being an active participant in the financial sector. The typical terms and the primary terms that get focused on is the distinction between the banked and the unbanked. The unbanked traditionally refers to those people who, while they do have money under their mattresses and pillows, don't really participate actively, don't have a deposit account, etc., don't participate in the regular financial institutions. And that poses a major problem for industry, poses a major problem for governments, and is a problem that academics like to study and find solutions to, which is why all 3 groups are here today. It matters for many reasons, because the banking sector plays a very special role in development. Access to banking not only provides you with access to financial capital, but enhances what you can do with the capital that you save. According to the World Bank, the highlight for those of you who watch CNN and programs such as that, when the World Bank and the IMF had their annual spring meetings in April, the primary highlight in all those stickers was the World Bank research report points out that over 75% of the world's poor are unbanked. And so the president of the World Bank at that time highlighted the key role that this plays in bringing people out of poverty, in making sure that across genders, across race, across ethnicities, everybody participates in economic growth. There are also lots of social benefits from financial inclusion. I'm not going to go through each of these. We'll make it available as the reports that we put out on the website. This is a study. Like I said, we are doing a research project here. We'll continue to build on this. But this is the first snapshot of something that Mark has put together. We found this data set from the World Bank. They just started collecting data across the world on the unbanked, specifically focused on that. And so what is shown here is that while you think of many of the traditional economies as having lots of people who are not participating in the banking sector, if you try to characterize them in terms of per capita income, look for if you had this per capita income in a specific country, and this is the percentage of people who have access to banking, does this economy, compared to others who have the same or similar per capita income, have a lot of people in the banking sector, in the formal financial sector? And so according to this, where the yellow is for the high-income countries, but going to low and low-medium income countries, the ones in the red are all those which have a banking deficit. So compared to other countries in similar economic situations, these are countries where the reach of banking is not very big. But countries such as India, such as China, certain parts of Africa, have all now, in 2011, moved to being in a banking surplus. Keep in mind, this does not mean that everybody there has a bank account. There's still large chunks of the population which do not. But compared to another country, which is very similar in economic profile, they are doing better. A lot of that coming out of the discussions that we had all day with Shahid and Epen are much more recent phenomena, because governments have been very active in this, private sectors have been very active in this, in trying to bring the benefits of participation in financial system to everybody in the world. Okay? So now that I've put all of you to sleep, I shall introduce our distinguished panel. The only thing not so distinguished about this will be my bald head shining over here. My role is to generate the same type of conversations that we had back in my office all day. Because we have two people who are fantastic experts on this subject. How much they know, I'm still reeling from. Shahid Charania. Now, the reason how Equifax played a key role in my picking this for the first issue, or the first initiative, is because they are involved in every emerging market that you can think of. They create these consumer credit profiles. For them, information is important. And if people are not participating in the financial sector, they don't have that information. And so banks cannot lend to people because they don't know whether you're good credit or bad credit. And so this is an issue that they have been dealing with for many, many years. It's through conversations with Shahid and his predecessor, Trey, that this became one of the first initiatives. Mr. K.V. Eapen, Shahid is the managing director for emerging markets at Equifax. He's been a major, major supporter of our activities. Anytime I bug him, he turns up to my events. Last March, he came to the India Summit at the Harley Center, straight out of Dubai. And so, but you could notice the jet lag in him. You could see yesterday's drinks on my face, but he was wide awake. So Shahid Charania, thank you. Please join us here. Epen is currently at the IMF. He's a special advisor to the executive director of the IMF. So when you think of the voting this person to be the managing director of the IMF, or the IMF voting on loans to this country, etc., It's Epen and his group that participate in those boards. He was prior to that, he's currently on leave from the government of India. He was prior to that the Joint Secretary of Banking in the Ministry of Finance. And this was one of the things that he was dealing with during his time there. His primary focus, or one of his many areas of focus, was to really, the reason why, if you looked at that graph, India was in the banking surplus, has a lot to do with the initiatives that were developed during his time. Epen also, unfortunately for him, went to college with me. And so we've known each other for many, many years, but I didn't know he knew this much. So it's a great pleasure to have Epen back. Please join us. So if I sit in the middle, then that will make me the true moderator, right? The referee. Like I said, we had really, really great conversations. Can everybody hear me? And so what I'm going to do is to just start the conversation off. They have so much to tell us about financial inclusion, and they will have more to tell us over time as we put together this report. Epen, if you could just start us off with a brief history of some of the initiatives that happened in India, why they evolved, and get this conversation going.
Thanks, Govind, and thank you to the KSU for and the ICA Institute for hosting this. I'm very happy that you've selected financial inclusion as an area of focus for the Institute, because in many ways it's an issue which cuts across all three countries that you're focusing on: India, the US, and China. I mean, most people would not think that financial inclusion is an issue in the US, but I understand that it is an issue, particularly in many deprived sections of the population, even in the US. So probably some of the initiatives that have been taken in India or in China can be replicated to an extent in the US, and some of the things that the US has done in this area could give lessons to India. In India, financial inclusion has always been looked upon as an extension of the banking services to the population, which is out of the entire banking fold. An estimate is that about 150 million households, the population of India, as you know, is over 1 billion, and about 150 million households don't have any access to banking. So we are talking about, if you take 5 per household, it's like almost a 750 million population almost with no access to banking. Now, it doesn't mean that they have no access to finance. That's a different thing. But they don't have access to formal finance. Now, I make this distinction because obviously people in the rural areas in India or in any other country need finance. So there have been traditional means of finance which they have been tapping, and that included community organizations. A big money lending class exists in the rural areas, which is traditional, which is hereditary. In fact, the son of a money lender also becomes a money lender, and which has always been there. But the problems of traditional money lending in an underdeveloped society, I think, are very clear. It often turns to be exploitative. The interest rates charged by money lending can vary from anything from 40 to 70% over a crop cycle, which is normally the time of lending. and so on and so forth. So therefore, access to and bringing in people into the formal financial system is an extremely important part of the development of any underdeveloped country, and India was no exception. So after India got independence, really, the financial inclusion initiatives started in the 70s when the Prime Minister at that time, Indira Gandhi, she actually nationalized 14 banks in 1971, and it became a mandate for banks to open branches in rural areas. There was a 1:4 ratio which was set up. That is, for every branch in the urban area, you had to open 4 branches in the rural areas. And that, in a sense, was the first kind of initiative on financial inclusion. Along with that, banks were mandated. This is now, it might sound odd to an audience coming from the US, but even in their credit to customers, almost about 24% of the credit had to be flowing to certain deprived sections of the population. It was called priority sector lending. The government said, these are the priority sectors, and 24% of your entire assets or your lending needs to go to these sectors. And these sectors included lending into agriculture, lending for SME, the SME, small and medium enterprise sector, lending to farmers. All that was mandated as part of the initiatives at that time. So one would have expected that these initiatives would have resulted in a larger and larger amount of the population getting into the formal financial sector, and it did to an extent, but obviously it wasn't much. And then, after liberalization started in 1991, really, I think this kind of policies were put a bit on the back burner. Largely, I now work for the IMF. The Washington consensus was very much, a market-oriented approach. This kind of structural initiative, saying targeting lending at people, like, frowned upon. Really, it was not the kind of ruling philosophy. But now I see it's come back in a sense. Industrial policy and specific mandated lending to areas and targeted lending has really actually had a second lease of life. And as part of that, really, financial inclusion has come back into the kind of policy framework, but this time in a much more organized fashion. As we go along, we'll talk about it. It uses the IT, it uses telecom, it uses also mandates. It's still a bit of there's a lot of mandate involved in it, but it is also an aspect of government policy and the regulators' policy that financial inclusion is part of the normal functioning of the banking system. So this is the background that I thought I would start off with, and we could go into details later.
Absolutely. Shahid.
So first, can I just kind of add to what my friend here just said? So obviously I'm from Equifax, so I have more of a business view rather than from a policy side of the view. So try to put that in a context of what he just said. When we talk about unbanked people and like he said, it's not necessarily they don't have access to the funds. They do have access to. But let's put that in a context of a business, what that really means, right? So if I go to an individual, Govind, and say, Govind, give me a money, right? He gives me money either because he knows me, right? Hopefully, or I have some sort of a collateral that I can give it to him, right? But other than that, there is no incentive. Why he would give me money is because he wants to charge me interest, right? So he will say, for sake of discussion, say 20% interest rate, right? I pay off my loan, I go next time. What is he going to do? He's going to charge me 20%, if not 25%, because now he knows that I'm in a more need and I don't have an access to a formal source of funding in our banking system, correct? So in the end of the day, my interest rate or my payback or my ROI is going to get worse and worse and worse because he's in the business of lending money as an individual, right? That's not to say the banks are not interested or not in a business of lending money, but In terms of when you look at what we call here, I'll use this word loosely, peer-to-peer lending, right? This is where people lend to each other. You are interested in saying, okay, now he's coming back to me, I'm going to charge more and I'm going to charge more. But the same individual, when he or she gets into a formal banking process, right? So what happens to the bank? The first time when you go and you get a loan, yes, you don't have a credit, you get to pay a higher interest rate. Second time when you go to the same bank, right, one or two things going to happen. Either they're going to give you better interest rate because now you have a history with them, and or higher amount, because now they know that you have ability to pay back. So if you play that out over 5, 10 years, or perhaps in generation, first or second generation, now you have created a mechanism where these people who've been unbanked, who've been paying high interest rate, these are the people who have absolutely necessary to have an access to it, but not had an access. So now you have created a system where they have access to the bank, and as a bank, they are in a business of lending money. So once you get a personal loan, for purpose of the discussion, you get a 1,000 rupee loan, you paid it back. Next time you go, as I said, you either get a better interest rate or you get a better, more money. Second, third, or fourth time, the banker will look at it and say, you know, he's keep coming back for a personal loan. Perhaps now it's a time to give him a revolving, i.e. the credit card. 6th, 7th, 8th, 9th time you go back and say, you know what, he's doing a very good. Now I should push him to get a two-wheeler or a car. So let me give him a car loan, or maybe give him a bicycle loan. So again, now this person who perhaps had a very limited access to at a very high interest rate, because he became a part of the system, has now much wider access to the finance and much more sophisticated products of the finance. So if you put that in the context of what we're talking about, financial inclusion and or unbanked, the effect of that over the years is significantly higher than continue to go to a money lending organization. So again, that's slightly a different view or more elaborated view of why it is important to give access or have access to the funds for this unbanked population.
Thanks. Wonder if one of you could also speak about some of the things that you see happening in the context of financial inclusion mechanisms.
Like I said, the real second lease of life for financial inclusion became quite apparent, and it started in the mid-2000s, around 2005, and it was taken up as policy by the government of India and also by, more importantly, by the regulator, the Reserve Bank of India. It is to an extent driven largely by policy. I mean, it's financial inclusion, we may talk about it, but I think for a large number of banks, it's still not very paying because, you know, opening branches in rural areas is not a paying proposition for many branches because the kind of business that is generated is perhaps not sufficient for them to be viable. So, so the policy really consists of the following. You know, banks are allowed to use the services of agents. We call them business correspondents in India, who are actually agents appointed by the banks in unbanked areas. And these agents are allowed to do basic banking services with the population that is unbanked. And that includes, you know, first of all, keeping small balances which are available. Then many of the transfers from the government, whether it's the state government or from the central government, is routed through these agents, through the banks, to the population in those villages. And a very, very big area is remittances. Internal migration in India is huge. You know, you have people who are migrating into the urban areas from the rural areas in search of occupation, in search of livelihood. And typically it's like they do migrate in families, but a large amount is seasonal migration where it's mainly males who migrate to work during particular seasons in agricultural areas, and they have to send their earnings back to their villages. And this an area of migration is the eastern part of India, the states of Bihar, where people go a lot across the country to work. And many of the initiatives in financial inclusion involve actually using the mobile telephone network and the infrastructure that has been set up in the mobile telephone field to send money back. You would probably have heard or even read, I don't know, actually the number of mobile phone connections in India are much more than the number of bank accounts. So the mobile phones are an instrument available with almost even the poorest of the person. He may be working as a rickshaw puller in a big city, living on his rickshaw, so he doesn't have an address, but he would probably have a mobile phone. And so the banks have used the mobile telephone technologies to enable him to transfer his his money back to the villages. So essentially, the initiative has used the strengths of the information technology, strengths of telecom, ICT as a whole, in order to sort of drive it at the next level. And so, really speaking, it's at a stage now where perhaps we could now look at things with these bank accounts and these initiatives going into the next stage, which is actually using these to provide credit. Right now, they're just providing basic banking services, but not credit. Now the next major initiative really needs to how to use this infrastructure to deliver credit for the small and medium enterprises to the people who need it, because that is still yet to happen. I think that's the next point.
When you speak credit, then Shahid has to come in the picture. How do we provide credit?
So, typically, every financial institute or anybody who's lending has some sort of a risk management process, underwriting process, which basically scores the behavior, for lack of a better word, or ability to pay back, and say if individual has an ability to pay back, and if he or she has a good credit history, you do lending, right? So the challenge here is, because you're dealing with unbanked, one of the things we discussed this morning, there are other attributes besides your ability to make a payment or how you make your payment can be utilized to initiate the credit. One of the things we talked about, as Epen said, you have significant amount of mobile subscriber, and people who are unbanked, even they have the mobile, right? So one of the idea is that can you take the data from telecom, right? And you look at how they're using their cell phone in terms of number of minutes they use, how often do they renew their SIM cards or prepaid, right? Because it's a prepaid system in India. So if I am making a payment or renewing my SIM card before my minutes expires, or I wait till it expires, or do I wait till it's down to 1 rupee, or I wait till I get an alert from my mobile subscriber, these are all the indication of how I handle my finance, or how my ability to pay back, and when my money is available. Because again, from a trend analysis, you can look at it and say, does this individual always pay on the 1st of the month? Is that when he renews or she renews the card? Is it a 15th of the month? Or do they renew it every day for 2 rupees? Because these are the people who get paid on a daily basis, and they only have 2 rupees to put on a card. These are all the mechanism by applying your predictive science or analytics to really figure out, while they perhaps may not have the credit history as financial institute would look at it, but they have other kind of data points that can create, and you can create and say, is this person have an ability to pay back or not? And again, if you look at from a banking perspective in the context of, again, India, right, they are also looking to grow, right? As we said earlier, there are probably 100 to 200 million people who have access to bank. When you look at the number of people doing borrowing in terms of credit cards, in terms of personal loan, education loan, whatever, it's even less than that. So 200 million people probably have access to bank. The borrower from there is even half of that, and perhaps maybe slightly higher than that. So how do you create a mechanism for banks to where they're also looking for where the new borrowers are coming from, right? So if there is no credit history available, is there a other data set available out there, which telecom comes to my mind immediately because of the high usage and the penetration that telecom has. And then you take that data and you combine that with the social data, that census data, and other economic data that is available for that region, right? Which is very common, again, in developed countries. If you look at it, one of the things Equifax does it is we look at your data, payment data, and we combine with data that is available for public forum and or different financial services data, and create a profile, what we call a 360 view of a customer, to say that this is not just how his borrowing or her borrowing is, but I can also tell you what assets this individual has. Does this individual have a home? Does an individual have a car? And if you live, and again, I give you for an example, in sort of, what we do in US, we look at what we call zip plus 4. Okay, so zip plus 4 is, when you get your mail, sometime it has a 30024-1234. That zip plus 4, I believe, is a 12 houses block. So when you see a number with the 4, you can pretty much pin down to this is a block of house. Okay? So now I can take that and say, if you're living in, and I use this as for example, if you're living in a bucket on Johnson's Ferry Road, from a state, I can get the information to what is the education level there. I can get the data on what is the average household income there. And then I look at that area and I can figure out what the property value is there. So perhaps I may not have the information about an individual, but I can get the information about a block, and I can predict that if you live in that block, you would probably have a similar profile, right? Now take it back to, again, in the Indian context, you take the telecom data, and I take the data of the village, which again, government has, to how many people have ration cards, how many people are using subsidized, your sugars and kerosenes and other type of facility, how many people are on pension, how many people are using other type of welfare program. I take all that data combined with the telecom data. Now I can create a profile for a bank to say how risky that person is. So those are some of the tools that companies like Equifax or anybody who's data can enable bank to create a programs for banks and government to be able to do a safe lending, is what we call, right? There's nothing called risk-free lending, but a scientific predictive science kind of analytics, and say this person is what kind of a profile that person is in.
Epen, I wonder if you could speak to us a little bit about microfinance institutions, because they've played a big role in this, as Shahid also has mentioned previously in our conversations, especially when it comes to women, small businessmen, etc. Those play a key role. So I wonder if you could elaborate on the role they play in India.
Microfinance, actually, the big center for microfinance was in Bangladesh, where Mahmoud Yunus was, the father of microfinance. You're all aware about that. In India, it is again something. It's a slightly different model from the microfinance model in Bangladesh. First of all, the microfinance companies in India used the existence of groups of women they're called the self-help groups, which were already there, and they were sponsored by banks and other institutions. And the microfinance companies which came and really actually used the existing groups in order to lend money to these groups. This was particularly popular in the southern states, essentially the state of Andhra Pradesh in the south. It became really big business because there were a large number of groups which were already there in the rural areas. All the microfinance companies did was that they contacted these groups. These groups were actually doing small microfinance activities in the sense that they were just like typically doing traditional microfinance, which is pooling their savings together using that to lend to each other and doing small activities. The bigger companies came and used these groups and started lending, much, much higher amounts to the group, which is good in a way, but the problem was that they started charging almost moneylender kind of rates. They went into 40% interest rate, 50% interest rates, and there was a huge political backlash against the microfinance companies, particularly in the same state of Andhra Pradesh. So the government then, this was about 2 years back, passed a regulation almost making it impossible for them to function anymore, because they laid out a lot of, the state government actually, and they laid out a lot of procedures, like for example, no microfinance employee was allowed to go to any house in the village. He would have to stay in the center of the village. So he couldn't go and threaten anybody. He would be right in the heart of the village, and people would have to come to him and do the business right there, and so on and so forth. So so there was a huge, this really it gave microfinance a bad name, so it became a kind of a controversial area, and that's where it is. And then of course the microfinance companies also went to court against the Andhra Pradesh ordinance. Then the court gave them some sort of a stay and all that. And right now, I basically look at it, microfinance is a very helpful tool, but it's also double-edged in the sense that unless it's properly regulated, you're dealing with the poorest part of society when you're talking about microfinance. And normally it's women also. That's the other aspect of microfinance. And unless you proceed very ethically, you have this problem. And I know many of these top 6 or 7 microfinance companies, actually, private equity guys operating out of New York were taking stakes in these microfinance companies, because they saw the returns of 40 or 50%. And they said, wow, where do I get kind of returns like that for my money anywhere else? And they were taking stakes, equity stakes in these microfinance companies. And one of them actually went to the Indian stock market and had an IPO, and so it became completely, different from what it should have been. And so it is, but coming to the topic of microfinance and financial inclusion, obviously microfinance, because it is aimed at the most unbanked sections of the population, aimed at the poorest people, it is obviously a great, great tool for financial inclusion, but it has to be very, very properly handled. Otherwise, it could be a problem. Yeah.
How would microfinance, from the perspective of lending, how do you think that could be made to be more effective and lead to more inclusion?
So obviously, like he said, I think regulation is extremely important. If you go back and historically, this is for the poor of the poorest, and the intent was to do it as a non-profit type organization. But over the years, it has become a profit. But the fact is that these are microfinancial institutions are the one who have access and or reach to these people, right? So if you can use those channels in more positive way, for lack of a better word, or in more regulatory way, it has a huge benefit. Because, so far we've been talking about what credit can happen, what bank can do, but there is a other factor which I believe is a huge factor, which is the trust and education. You are dealing with people who are farmers or women who's borrowing money for sewing machine. Either their husbands are passed away or husbands are moved out, or whatever social issues there are. So these people are not well educated, right? And the fact that even today, even myself, when I don't see a money, I was like, okay, did my check actually get deposited? Do I actually have a money in the bank, right? So, and this is, we're talking about developed countries and whatnot. Right now, just go back to people who are so used to getting money on a daily basis, 2 rupees, 5 rupees on a daily basis. All of a sudden, you're going to go to them and say, don't worry about it. Use this cell phone. your money is in the bank, right? There have to be a huge amount of education that needs to happen to tell these people that your money is there and it's safe. And then with education goes the trust. And again, all of that, MFI can play a very key role because they have access to it. And the way MFI works is basically, there may be one or two at most MFI for a village or for a region, so they know people by name. So when people borrowing money, it's not they're borrowing money from the microfinance institution ABC. They think of that they're borrowing money from Mr. So-and-so, because he's the one who's going to that village every month, every week to give money or collect money. So there's a huge amount of trust. So if you can take that same channel and the energy and the access that you have and turn it into more positive where you can create a trust and education, MFI can play absolutely a key role in converting these unbanked population into bringing into the mainstream banking.
Is it from a political or government perspective feasible to do that?
Sure, because as Shahid said, there's no question the microfinance organizations like the cooperative societies, which are the other rural-based organizations, are the closest to the rural customer. And there are also urban, by the way, urban microfinance companies. It's not that they're just in rural areas. There are companies working in the urban areas among the urban poor. There's no question the microfinance company operating in 2 or 3 districts of a state knows the customer the best. The customer has got, the people that bear the best, they have faith in the microfinance company. But, the way they operate, it needs to be properly regulated. At present, they're not allowed to tap savings. So, they're not allowed to keep money with them. They're only allowed to lend money. So that's the other point about microfinance. So they don't provide the whole gamut of banking services. They only provide the service relating to credit, which is important, but it's important also to draw people into the formal financial sector, like we said in the beginning, in where they are, they get a 360 degree kind of access to banking. So recently, because of all these problems of microfinance companies, many of them have started changing their character. They have become agents, business correspondents of banks. So the bank, that's I think a positive development. The banks can use, so they are like regulated by the bank then. So the bank knows like it has to, if the microfinance company does something wrong, the reputation of the bank goes down. So there's a better stake in that kind of system where they're acting as agents of the bank.
What role does gold play in all this?
Oh yeah, we had a very good discussion about gold in the morning. Gold is like one of those things in the Indian context. I see a lot of people of Indian origin here that they all know about it. It's one of those, in India, everybody has gold. Whether it's like, the poorest of poor or the rich. Because it was like traditionally looked upon, culturally looked upon as the kind of the metal of choice. One which gave you the best security, because it was like, those government bonds, where, it had the same kind of, safety. But it's at the end of the day, gold or jewelry is dead. What does it do by itself? It's just sitting there, but it's of no use. So a big development in the last 5 or 6 years is the rise of non-banking finance companies using this gold to give credit. Now, so this is something which has really happened in the last 5 or 6 years. So tremendous growth in that particular area of the financial services industry. These are called gold loan companies. Simple, and essentially what happens is that people with gold, families with gold, come to the company. They are gold assayers who look at, you can right at the branch, actually test for the purity of the gold, and depending on the purity, they have the price of the gold right there at that time, and I think up to about 70 to 80% of the value of the gold is immediately given as loan, and so all happens within a day. So, but again, they charge pretty high interest rates. And unfortunately, again, the loans are really not productive in the sense that they're taken by a large number of poor people to meet debts or to meet unforeseen expenses like health expenses and so on and so forth. So it's not a very positive thing. But if it can be kind of channelized in a positive way, it could be an excellent way of getting people into a formal system, from an informal system.
No, as he said, it's a recent phenomenon. It's pretty much driven by because of the price of gold has gone up so high. So obviously all the banks are capitalizing on that to get that. And it's the most safest form or collateral, right? That it's not your car that you have to go drag down if something happens. It's not your house where you have to go try to sell. This is a gold that's in bank's hand. So it's the most safest, so to speak, collateral that you can get loan against. Two things there. One is, as you said, I think, gold is a very cultural thing in terms of India. This is something people buy for rainy day, or that's just something they would look for in terms of asset. And there's two aspects of it. So while it's a debt in terms of it's just sitting in somebody's house, if it can be used in a form of not necessarily because I have some unforeseen situation and I'm trying to put my gold for collateral and trying to get money, but rather that you can use gold as a collateral when you're buying a refrigerator, right? Or when you're trying to buy, furniture, something that is. So what happens is now you have turned something that is dead into more cash into the economy, rather than turning something that is dead and pay for your medical bills, right? Well, that is still a form of money coming into the economy, but not necessarily the same way of coming money into the economy as I'm going by a refrigerator or a furniture or something else. So I think there needs to be some sort of, I don't want to call it regulation, but some sort of at what cases can you give gold loan and what is the purpose of the loan, such as similar to, if I can draw a parallel to, when you go get an education loan, people give you education loan to go get education, right? It's labeled as an education loan and then you take that money and go buy stocks, right? So that's that. Now, this particular issue is very close to my heart as well because I believe, again, when people give gold for loan is when you are at the bottom of the bottom. So while it's a very good business in terms of return and safe and all that stuff, you now really have taken advantage, right? And I don't want to get too social here, but it is an issue that I think over the next 5-10 years is going to play out, where you're going to find out that a lot of people have put gold as a loan collateral where they actually were needing in money, and that you have actually now taken advantage of somebody who is at the bottom of the bottom. This is when you go out in the context of India and put a gold for loan, right? That's kind of my opinion. That while it's the same thing, right? A lot of time people talk about when we had Hurricane Katrina, right? That the big one in Louisiana, correct? Insurance companies, right, made a lot of money, or have paid out and whatnot happened. Or when we talk about unemployment, payments being processed, and companies who process payment, their profit goes through the roof. But on the other hand, on the other side of that equation, there is a social issue where you are processing unemployment, when the people are in most amount of need for the money. So again, as I said, didn't mean to go on a tangent here, but it is an issue. It's very close to my heart that I believe that it has to be done properly and should be regulated in a form that it is not misused.
What about the identification, the social security numbers that they're working on?
So there is a big effort going on. You probably have heard about it. It's called UID, Universal ID. I believe now they have captured somewhere about 200 million people in this database, so somewhere about 20% or 15 to 20% of the population. But they are, right now they're collecting a very limited information. I believe they're collecting 5 or 6 attributes like name, address, date of birth, things like that. But really, if you want to really encourage, again, who you're collecting data, this is not your metro, right? These are not your big cities. You're trying to go in a rural area, trying to create, awareness and saying you should get an UID, and here's the benefit, right? If I am the guy, who works in a farm all day long, what is the value to me when it comes to UID, right? So I think that program would be much more beneficial if you try to connect that with some of the other programs, government programs you have. So for example, one of the things that is very common in India is you get a ration card and you get subsidized sugar or kerosene or rice, those type of things. There is a significant amount of misuse that happens there, where an individual who's supposed to get a 2 kilo of sugar only gets 1 kilo because somebody else has come and gotten the kilo of sugar. Now, if you can combine some of those social programs, social welfare programs, or pension, for example, right? A lot of people get pension, but it's not that they don't get it, but the process of getting the pension to those individuals is very cumbersome, it's very complex, it's long, right, to get the money. So if you can connect some of these social program or government program to UID, now somebody who sits in a village, who works in a farm all day long, if you come to me and say, look, you get a UID, if you get a UID, then you can go to the local merchant, and because of that, you will get your 2 kilo of sugar. Now there is an incentive for me, right? And it will also create an ecosystem where government will also have some amount of savings, or for lack of a better word, less leakage in terms of whether the pension is going to the right people or not, whether there's subsidized form of sugars and all those stuff, are they getting to the right people in the right amount or not? So I think while UID is a fantastic program, but I think it could be much more beneficial earlier on, and can get much faster penetration if it gets connected with some of the social programs.
Epen, as we wrap up, if you can summarize a couple of key things that will or should happen in order for the unbanked to transition into the bank sector.
Yeah, I think the present program really is, I didn't talk about it. What is right now being done is that the Reserve Bank of India, the regulator, is actually told each bank to draw up a financial inclusion program for itself. And this actually involves giving banking services in the first stage to habitations with at least a population of 2,000 which don't have any banking facility at all. So they can use the service of the agent, the business correspondent, while doing it, or they could have a actual physical bank branch. So this is the first phase, really, to provide the service. But like we said before, the more important thing is how is this service going to be utilized, It's not important just to provide the services if it's not utilized. And an estimate is that there are already a large, about 75 million bank accounts, they're called no-frill accounts, which have been opened but lying unutilized. So therefore, there is no point in just opening a bank account. It is important to combine it with utilization. And that's where the whole area of financial literacy, which we haven't talked about much, is important. Because it's important to convince the person who's to use the account to also know the power of actually finance. What is, right now he or she doesn't see the incentive of opening a bank account. They do it because they know they won't be able to get their transfers like old age pensions or their wages unless they have a bank account. So they know that they have to open an account just to get the money, the transfer. But they don't know about the power of a bank account in the sense of utilizing it to get credit for themselves, to improve their livelihood, and so on and so forth. And that's where literacy comes in. Many of the financial products that have been introduced in India, particularly, for example, rainfall insurance, which we are talking about in the morning. Rainfall insurance is very important in India because agriculture is so dependent on rainfall. So, a product like rainfall insurance, one would have thought would have a lot of traction in India because it actually, protects people from, the lack of rainfall. But it hasn't taken off, and the reasons are financial literacy. People don't understand, they don't trust the fact that if I pay money to the insurance agent, if there's a problem, I'll get money back. They don't have that trust. So all those things are very important to develop. So I would say yes, so literacy is important. Utilizing the accounts which are open is important. Of course, extension of banking services further and further into the is also important. But along with that, these other things have also to be combined.
In what ways, Shahid, do you see the private sector getting engaged? Companies such as Equifax?
So again, as I said, companies like Equifax has a significant amount of data and the expertise and analytics expertise to really understand the data and the things that I just mentioned, to take unbanked people, can you score them, can you figure out and make, can you get banks at somewhat a comfort that these people have an ability to pay back or will pay back similar scores. So there are products like that which I believe people like Equifax can come in and contribute because they have certain expertise from not just the unbanked but the behavior of the banked population, different population around the world, different way of using money, paying back, all of that, right? When you combine that kind of a global expertise, I think you can create a model where you can, score and segment people to help bank to identify those unbanked population.
Fantastic.